Welcome back to Let's Talk Tax. I'm Dave McGuire. Today I'm joined by David Seibel as we discuss the July 6th R&D deadline and what it means for CPA firms. David, thank you for joining us.
Thanks for having me, Dave.
So, David, I know that the 174 was a big issue the last few years.
Mm-hmm.
Obviously, there were a lot of changes. Talk a lot about the One Big Beautiful Bill. People are all excited because we've got 174 direct expensing back. But then there's this July 6th deadline. What does that July 6th deadline actually mean?
Yeah, so there were a few different options for taxpayers regarding how to accelerate 174 deductions. So there's the 1 year or 2 year accelerated deductions that they could do on the 25 or 26 returns. And then there's also this small business election that enabled eligible small taxpayers that are defined as having gross receipts under 31 million over the 22 through 24 years to actually apply retroactively 174 expensing to the 22, 23, and 24 years. That's important to note that that election is only good until July 6th of 2026 of this year.
So if I'm going back and amending the old returns, I have to do that before July 6th. What if my extension date doesn't actually come up for another 6 months? I still have to deal with it on July 6th?
Correct, yes. So that's the due date of the election. That's just one option that's available to those eligible small taxpayers, but that's the deadline to make those elections. And then another thing you have to consider too is if you're going to run into any statute date for 2022, because that does not automatically extend the statute date to July 6th. You have to take that into account separately.
You mentioned the July 6th deadline, that it's coming up. What about people that are on extension? What about people that have other statute dates? Is this trumps those, or does the statute date still have to come? How do they all interact?
Yeah, so the July 6th deadline is for just electing that small business provision. You still have to keep in mind the statute dates for the 22, 23, and 24 returns, which for our purposes, 22 would really be the only statute date worth looking at. But just because, say, for example, you had filed a return originally filed on 22 on March 15th, 2023, the statute date still applies of March 15th, 2026. So that does not automatically give you an extension of time to amend to July 6th.
So this is just the small taxpayer exemption, but the small taxpayer can go off the standard change, correct?
Correct, yeah. So they again, that's just one option that they have at their disposal. They can still choose the accelerated deduction options, whether that's deducting all the unamortized 174 deductions on the 25 return, splitting them ratably over 25 or 26, or just letting the 174 amortization schedules continue to run their courses and while still being able to deduct their 174A costs, research costs on the 25 returns and going forward.
So let's say I'm a small taxpayer and I don't want to go back and amend those returns.
Mm-hmm.
Obviously, we're past tax season. Let's say I'm on extension. Can I just let this ride, or is this a current year election that I need to worry about right away?
So this will be a current year election. So for the 25 return, you have to decide, how am I going to apply 174A and going forward? If you're doing a small business election, what you're actually doing is making the 174A tax code apply to 22, 23, and 24 and going forward. If you're not, you still have to apply some election statements on the 25 return to make the decision of what are we going to do, deduct 174A costs in 25 going forward, continue to amortize, and then also making the decision of whether you're going to do the 1 year or 2 year accelerated deductions. So those all need to be done on the 25 return.
So if I'm just going through the math in my head, let's say I'm a small taxpayer, I've got $1 million in 174 costs. I'm talking about 3 years.
Mm-hmm.
So I would have taken $100,000 1 year, $300 another year, and $500 another year if I'm doing my math right. So I'm sitting on $2.1 million in deductions. That's a pretty important deduction that people are looking at, that I've got to decide, do I go back and amend do I pull that forward? Do I take $2.1 million in additional deductions this year? Or I spread it out evenly between 25 and 26? Am I looking at that correctly?
Yeah, you are, Dave. Yeah, so it's really, you're right. The decision of where does that 2.1 million go? Does it go in 22, 23, and 24? Does it all go on 25? Does it go on 25 and 26? Or again, do we just let those amortization schedules run out? So it's a pretty important decision. Obviously, a lot of dollars at play, even just for that $1 million example, which probably applies to the vast majority of our clients have those $1 million in costs. So it's definitely a real decision that they have to figure out and what's the best situation for them. And, that's just one small factor of the equation, not even considering all of the other tax provisions like bonus, QPP. It's, again, just one factor in the decision that taxpayers have to evaluate.
Yeah, I think it's going to be an important year, especially for those things like you're mentioning, the 174 costs, the QPP. A lot of these things are current year elections. We're not going to be able to go back. Elections in and out of bonus, we can't change those. Now, depreciation, obviously, we can change through a 3115, but we're going to be dealing with a lot of these this year. So that's a good point that you have. What are we starting to see on the state level? Are we seeing states? I know we've seen some states adopt out of federal compliance. Have we seen anybody adopt in yet, as of today? Obviously, when we're recording this.
Yeah, I mean, it's always a continually evolving situation because particularly those states that have static conformity, where they conform to the federal code as of a certain date. There's a couple of states out there that are looking to get into 174 compliance, so shift their date up to when the One Big Beautiful Bill was passed so that taxpayers can deduct their 174 costs. So a lot of them do decouple from certain provisions, kind of similar to what they have to do for bonus and things like that. So a lot of the states are not complying with like the small business election or the accelerated deductions, but they still want to be able to have their taxpayers be able to deduct research costs going forward. And then to your point, there have been certain states where they've said, we're going to specifically decouple from 174. They still have that either rolling conformity date or they've set that federal conformity date to comply with most of the other provisions of the One Big Beautiful Bill, but have, again, separately decoupled from 174 provisions. So their taxpayers have to continue to amortize those research costs for state income tax purposes.
So we've been talking a lot about this 174, 174A compliance and how we're getting back to a point where we can expense those R&D expenditures.
Mm-hmm.
I know since we had this change where we had to amortize them, we've seen people pull back from R&D tax credits thinking that Section 41, which covers the R&D tax credit, and 174 that covered the amortization were linked. As we're seeing the ability for people to immediately deduct 174 costs, are we seeing more people kind of going back to the 41 R&D credit, even though they shouldn't have walked away from it at the beginning?
Yeah, those are conversations that we're continually having, especially for those taxpayers who have made that decision where they didn't want to. They thought that not claiming the R&D credit excused them from amortizing 174, even though that was not the rule that was in place. It was, companies still had 174 costs regardless. That was mandatory, but claiming the research credit was optional. So we have had, now that there's more favorable treatment, taxpayers coming back to say, okay, let's pick things up right where they left off. Let's maybe look back and amend 22, 23, and 24 to claim those credits, or maybe let's just concentrate on 25 going forward. But there has been a lot that has changed over the last couple of years, at least in regards to kind of some of the documentation requirements involved with not just amending returns, but also claiming them on originally filed returns and going forward.
Can you give me an example? You say that, in this meantime, when we've been dealing with 174, you're saying the documentation for the R&D credit itself has gotten more stringent. Can you give me an example of what you're referring to?
Yeah, so for all amended returns, for R&D credit claims for refund, it's not just the simple exercise anymore of filing the 6765 and then sending it to the IRS to get processed. They've required additional information that's needed for those R&D credit claims for refund. And that includes a list of the projects, the business components being developed for the year, as well as the research activities that are being performed, as in a breakdown of the total QREs for the year. So again, that's a little bit different than maybe a couple of years ago, where taxpayers were just used to, maybe they did a study a while ago that involved amending returns. It was just the simple 2-page form that had to be filled out to be sent in. That's no longer the case anymore. So taxpayers that are hoping to go back and just amend 22, 23, and 24, they have to know that there's a little bit of a heavier lift that's needed to be able to fully process those claims.
So you're saying that if you worked for me as an engineer, I can't just go on and say, about 30% of your time's in R&D and just take that as a tax credit anymore?
Correct. Yeah, you have to be able to link people to the projects that were being worked on. So there has to be that due diligence of evaluating the credit claims based on what projects qualify for the 4-part test, where was the uncertainty, where was the experimentation, and then also being able to link the people that performed the research to those projects.
And is that those requirements, are those there today, or is that getting worse? Where is that a stagnant thing? Is that just the new normal? Where did that come from, and why are we dealing with that?
Yeah, so the requirement that I just talked about is strictly for amended returns. But then last year, for the 2024 tax year, the IRS actually revised the Federal Form 6765, which is the credit, the form needed to claim the R&D credit, to require a little bit more detail than just the number of wages, supplies, and contract research, the QREs, the calculation, everything, to require, again, some of the information that you see that is needed for amended credit claims, like how many business components were developed during the year, as well as what were the officer wages that were included as QREs, because that's a big audit topic. Were some of the QREs determined by some of these other methods, safe harbors that are allowed as calculation methodologies? And then there's also this other form that's been part of the tax form that's been optional for the last couple of years for 24 and 25, and that's called Section G, which again greatly expands the level of detail that's required, where it's necessitated to not just have the number of business components and a list of the business components, but also a breakdown of the QREs associated with those projects as well. That is, again, optional for 24 and 25, but then will be required for certain taxpayers going forward in 26 and going forward.
So it sounds like I've got a lot to think about as I move forward, because I've got to think about how I'm handling this 174, and based on what you're telling me, I can't sit on that, because I've really got to decide by the time we publish this podcast. Really, I'm sitting with a couple months, right? And I've got to make that decision. So I really need to probably have made that decision yesterday. Even if I decide not to use that and I don't have to worry about July 6th, I've got to worry about this before I finalize my 2025 return, because if I push it off, I don't have any other options. And if I miss that ability, now I've got to sit here and look at my R&D claims, because you're saying it's more complicated. It would be hard for somebody just to dabble in R&D claims, it sounds like. It sounds like it's getting more and more specialized as years go on.
Right. And I can't even count the number of times that we've consulted with CPA firms, their clients, just to walk through the various decisions that they have to make just from a 174 standpoint. We don't even handle any of the other parts of the taxes from the R&D credit department. It's just, can't even count the number of times that we've consulted with CPA firms and their clients just on the options that are available, just from not even from the rest of the taxes that they deal with, just from an R&D perspective and a 174 perspective, on outlining these are the options that this particular taxpayer is eligible for. From a 174 perspective, here's what we need to be able to properly substantiate the amended returns if they're going back for a small business, amending 22, 23, and 24, and then just even consulting with these expanded requirements and trying to evaluate with taxpayers and their CPAs. Here's the information that you have. Here's how well you're prepared for Section G, and here's some things that you could work on going forward.
Now, when I'm thinking about all these things, because obviously there's a lot to think about, and before we wrap up, I know are there other things I need to think about as I'm making this decision in the next couple of months? I seem to remember that there was an election for a reduced credit for some taxpayers, but that went away when we were amortizing. I'm assuming that's back.
Yeah.
I'll let you tell me the numbers and letters behind it, but is that something that I need to think about as I'm making this decision?
Yeah. So, yeah, what you're referring to is the 280C election. So, prior to 174 amortization, the way the 280C election worked is that if you claim the research credit, you would have to either deduct the amount of the credit from your deductions, or you could take the 280C election and take a reduced haircut by the maximum corporate tax rate in lieu of reducing your deductions. So, for example, if you claimed $100,000 in credits, you would either have to reduce your deductions by $100,000, or you would have to take the 280C election and claim a $79,000 credit.
You just mentioned that you reduce it by the corporate tax rate.
Mm-hmm.
Let's say I'm a pass-through entity. I'm not taxed at a corporate tax rate. I'm taxed much higher. So it sounds like in some cases I might be better off taking that 280C election, because if I add, let's say I've got a $100,000 tax credit, if I got to take a haircut on it at a 21 corporate percent versus my personal tax rate of, say, 35%, I'm going to be much better off using the 280C.
Yeah, for most taxpayers that are flow through, it makes sense to elect that 280C. Even for C corps that might just be a wash, a lot of state income taxes have that federal taxable income as a starting point. So if you don't take the 280C, you'd essentially be erasing your taxable income and might result in some higher state taxes too. So there are certain situations where you wouldn't want to elect the 280C, but in general, it's beneficial to do so. So the important thing to note, circling back to our discussion for TCJA purposes, the rules kind of changed a little bit where it didn't really make sense. But with one big beautiful bill, the 280C election that was in place pre-174 amortization has returned for 25. And if you're applying 174A as a small business for 22, 23, and 24, those 280C rules will apply, but you're able to make a late 280C election on those 22, 23, and 24 returns.
Well, it sounds like we've got a lot to think about. Obviously, hopefully people are watching this in a timely fashion after we release this episode, because it sounds like they really need to sit down and talk to their CPA.
Correct.
Really yesterday. And we're almost behind the 8 ball already. Between that, as you mentioned, the new 168N, the qualified production property, that's a current year election. You've got elections in or out of bonus. How do you, I think it's going to be a weird year where, especially on the manufacturing side, where people have R&D credits, production property, high capital investments through bonus. It's going to be a weird year where people might have too many deductions to use. So that tax planning is going to be critical.
Yeah, it's absolutely going to be essential. There's a lot of deductions that could potentially be captured. And like you said, you don't want to have too many deductions. So being able to properly plan that out is essential. And like you said, probably should have been yesterday, but the best time, if you haven't done it yesterday, is today.
Well, thank you. I think that's it's important. It's nice to hear that really with this change, R&D credits are a little bit more strengthened, and it's going to be critical that people are doing it. I think one of my takeaways is that the complexities of the R&D credit it seems like it's getting more valuable every year, but it's getting more complex. For those of us who obviously were engineering and science majors, it's kind of the law of entropy. You always move towards more entropy. So they always get more complicated, not less.
Correct.
So I apologize to all the people that just looked at us and said, okay, there's the engineering nerds on the podcast. But we're moving away to a more complex situation, but yet a more valuable at the same time. So I think it's critical that people are going to be calling and asking those questions, especially in the near term. So if somebody is watching this today that has not made a decision on 174A probably needs to pick up the phone and go, hey, David, I need to get your advice on something as soon as possible.
Yeah, absolutely. And even if someone is watching this after the July 6th deadline, again, that's just one option that would be no longer available. Doesn't necessarily mean that they can't go back and amend to claim the credits. They can't prepare for some of those updated requirements going forward for 2025, 2026 and beyond. So definitely never too late to have that conversation and see what is needed to properly substantiate claims going forward.
Wonderful. Well, thank you for your insight today. I know I learned something, so hopefully other people did as well. So I appreciate your time today, and thank you for educating us on the changes to 174.
Thanks for having me, Dave.